Hello and welcome to this week's Market Matters weekly video update. It's Harry here, joined by James Garish. We've got a few things to touch on today, James. Firstly, we're going to talk about portfolio performance for FY22. Obviously, it was quite a difficult time in markets generally. We touched on that in our last video together. But talking to our portfolio specifically, how did we do in FY22?
Yeah, so as subscribers know, we run 5 portfolios on the Market Matters website, ranging from Aussie equities to international equities and a global macro ETF portfolio. So starting from our flagship growth portfolio, which we've been running for the longest, it was down about 5% this year, which is not ideal. The market was down more than 7%. So obviously, it was a challenging period, no doubt. We outperformed for the first 3 quarters of the year, and the last quarter was a bit of a challenging one for us. So slightly better than the market, but not where we want to be. In terms of the income portfolio, it was the only portfolio across our suite that actually had a positive 12 months. It was up nearly 2%, which again, on the backdrop that I just spoke of, is a really solid performance. It does have a cash plus 4 benchmark, so it's slightly underperformed its benchmark, but again, against the backdrop of volatility in equity markets, I'm happy with the 2% return that portfolio delivered. The emerging company space was really challenging. We were down 23% in that portfolio. The small ords was down around 20%, so some slight underperformance this year, coming off the back of a pretty strong start to the life of that portfolio. The international equities portfolio did slightly better than the US market. So US market was down about 12%. This portfolio was down nearly 11%. So again, not ideal, but we had a larger component in technology, which has hurt us again in the last quarter of the year. And then the ETF portfolio is a macro-driven portfolio. It was down 8% for the year. So, I sit here and think about the last 12 months. I'm glad it's over. I think there's some really strong opportunities being thrown up in the market as we speak, and that's what we're going to be focused on throughout the next 12 months and beyond, Harrison. All right,
there was a big print last night from the macro standpoint in the US. Inflation data, I think it was the highest in 41 years, James. That's a pretty hot topic at the moment, and that's sort of what's driven markets for the last few months and weighed on equities. What's your take on that print?
Yeah, it was 9.1% year on year. The market was looking for 8.8%, so slightly above where the market expectations were sitting. And, there was a big negative reaction from US markets initially, but then they recovered pretty strongly. The Nasdaq was down nearly 2.5% at its worst and closed down 15 basis points. So that was a pretty strong recovery over in the US market, I guess. So you read into different, you read into reactions or try and get insights into how the market's positioning based on reactions like this. So obviously traders were positioned for a strong, hot inflation print. When that played out, they covered positions, and that's why the market bounced following that. I think the composition is interesting. So it's all, the primary driver of inflation is energy prices. We know that energy prices have come back in recent times. So, the question we asked in our AM report today was, has inflation peaked? And I think that's going to be the key driver in terms of markets going forward, whether it's, 8.7 or 9.1, really it's around the trend. So we need to see a peaking out of the trend. We haven't seen it yet. But given what bond markets did last night, given what currency markets did, there wasn't a huge amount of concern or added concern. I know inflation's a concern, but there wasn't a huge amount of added concern or added de-risking to portfolios as a consequence of that print, Harry.
Perhaps central banks' moves are starting to take hold and markets position for that, I guess.
Yeah, I think positioning the market is really key, and also sentiment. So markets are not pricing what we're seeing here and now, they're pricing the future. So what likely comes next? So the likely, what comes next is probably a peaking of inflation, probably some easing of supply chain issues that are feeding into inflationary numbers and the like. So markets are forward-looking, and that's the way we've got to sit here and approach our portfolios from that standpoint.
July can feel like a bit of no man's land some years in particularly the Aussie market. August is a big reporting season. That's what's sort of coming up next. As we head into reporting season, what should we be looking for when companies come out with their FY22 numbers?
Yeah, I think I was asked this question yesterday around, what's this reporting season going to look like? I reckon there's going to be a lot of fireworks. So if you think about, the challenges of the economic backdrop or the uncertainty from an economic perspective. So you've come off this, the big rebound coming out of COVID, but then you've got all these other factors, tight labour markets, inflation, uncertainty around inflation, interest rates ripping up. So I think it's a case when we've seen it with analysts, like there hasn't been a lot of downward revisions of earnings because I don't think analysts have got a really, I don't think companies have got a great handle on how the economic backdrop is influencing the next 12 months, and I don't think analysts do either. So I think there's going to be some big beats and some big misses reporting. So fireworks would be my view, but I don't think it's a case where I don't yet think we'll see some, I think the earnings will hold up fine in FY22. Outlook statements will be key as always, but it's around having tangible things that companies are doing. So in an environment like this, top management teams can manage it. Crappy management teams can't, and I think that'll really shine through this reporting season. So I'm really pumped for it. I think it'll be it comes around for your reporting. It's always a good time to get a pulse check on companies, and I think this year is going to be particularly interesting.
Is there a section of the market you're looking at in particular for a big beat or a big miss, James?
I think so. Beats and misses are I guess, relative to where the market's positioned or where the market is. Whether they're over optimistic or over pessimistic. Retailers spring to mind. We've obviously wrote about them this morning. The market's hugely pessimistic on the space, so I think that sets up for beats. I think the property space. So I think there's a real chance that property companies will beat from a distribution point of view. So higher dividend yields than the market is anticipating because the market's got really super bearish on property for what comes next, not what has just been. So office, we don't own Dexus, but office springs to mind. I think this work from home thematic is a ruse. I think we're all starting to see it in the city, people coming back to the office, whether that's 2, 3, 4 or 5 days back to the office. I don't think the huge exodus into permanent working from home will last. Things where the market has gotten so particularly bearish a particular area. Resources on the other spectrum, I think obviously prices have dropped, so this is probably irrelevant for prices, but I think the payouts, the distributions that are factored in for resource companies are probably going to be too high. I think resources companies will say, there's more volatility out there, we're not going to pay back as much in dividends. So I think we'll probably see underwhelming dividends from the resources part of the market. Swinging
back to retailers and office, James, we had an unemployment print today, which was a massive beat. I don't know if I've ever seen unemployment drop by 0.3 and participation rate go up. That would generally feed into positive consumer sentiment. You tend to see more retail spend. On the flip side, you're also seeing people come back into the office because they are employed and people need to work from somewhere, I guess. We did see at the start of this year a lot of companies miss and not really provide firm guidance because people were working from home and there was a big call back to the office. You basically saw it middle of February when the first half results came out. There was a massive call all through the papers, all through the media. Everyone I was speaking to have gone, all right, we're shutting off your access from home. You're all coming back into the office. Yeah, I think you've touched on some pretty good points there with the retailers and property in particular.
Yeah, and it's that dichotomy between the economic conditions we're seeing. Things are strong. The unemployment rate shows that people have got jobs. People have got they've experienced some pretty significant appreciation in their major asset, which is property. Share prices up until this, share markets up until this year have been really strong coming out of COVID. Savings rates are high, and all of these things are really strong economic indicators. What you've mentioned that now we're getting some concern about inflation and all of that, but we're not seeing it really in weakening economic numbers. We're only seeing it in sentiment surveys and the like. So to me, we've got to play what's in front of us at the end of the day. That's the main thing in markets. Eyes up footy, like the Queenslanders played last night, and make decisions in a timely way. I think in this market's going to be key.
All right, that's all for today. I hope you look out for future reports and enjoying Market Matters 3.0.